All right, let's get right into it. We're looking at a pretty bold forecast today, one that says 2026 is going to be a pivotal year for artificial intelligence in the public markets. We're going to explore why this might be the moment the AI revolution moves from just exciting stories to cold, hard numbers. So here's the big question on everyone's mind, right? When does all this AI hype, all this promise, stop being theoretical and actually start showing up in the earnings reports? Well, the analysis we're digging into today suggests that the foundation for that massive shift is already being poured. And just look at the foundation for this. I mean, this whole wave is being built on an absolutely record-breaking $252 billion in global private AI funding in 2025 alone. That is a staggering amount of capital betting on this future. And get this, it's not just investors throwing money around and hoping for the best. We're already seeing real results. In 2025, an incredible 75% of companies reported a positive ROI on their AI spending. That's huge. It marks this critical shift from, skepticism to actual measurable gains that businesses just can't ignore anymore.
So what happens when that confidence starts to build? Well, it fuels an insane amount of spending. We are looking at a forecast of up to $600 billion in annual AI capital expenditure. And a huge chunk of that is going straight into the nuts and bolts infrastructure needed to power this entire ecosystem.
What's really fascinating here is the economic backdrop for all of this. It's like we've got a kind of perfect storm brewing. You've got stable GDP growth, inflation is cooling down, and you've got this potential wave of blockbuster IPOs from giants like OpenAI and Databricks. I mean, that could just inject a massive amount of new capital and excitement into the market. Okay, so you've got all this money pouring into the system. Where is it going to land first? The argument here is that the most immediate, the most durable gains, they're not going to come from the flashiest new app. Nope. They're going to come from the companies providing the fundamental picks and shovels for the entire industry. And this is the perfect way to think about it. It's just like an old-school gold rush, right? The folks who really made the reliable money weren't always the ones digging for gold. It was the people selling the picks, the shovels, the blue jeans. They profit from the entire wave of activity, no matter who strikes it rich. Now, this table breaks down the unique power plays of the big four infrastructure players. You've got NVIDIA, which just has this chokehold on the silicon and the software, the whole stack. Then there's Microsoft, and they're just capturing value left and right through Azure cloud workloads and these deep integrations like Copilot. Amazon is winning on pure cloud consumption with AWS, and Alphabet is leveraging its own massive infrastructure while souping up its crown jewel, search, with AI. All right, so that's the foundation. Let's move up the stack from the raw infrastructure to the application layer. Because up here, the value is flowing to the companies that already own the customer's workflow. They're not starting from scratch. They're using AI to make their existing dominance even stronger. The core idea here is so simple, but it's incredibly powerful. AI's value naturally flows to the platforms that are already essential to how a business runs. If you already control how a company sells, or designs, or manages its IT, you are in the absolute perfect position to cash in. And you can see this playing out with the big names, right? Think about Salesforce weaving AI right into the heart of the sales process, or Adobe supercharging creative work with tools like Firefly. They, along with ServiceNow in IT and Intuit in accounting, they're not just adding gimmicks. They are strategically using AI to make it way harder for customers to leave, to justify higher prices, and to turn their products from just useful tools into absolute necessities. And as these AI models get more and more powerful, they just get incredibly thirsty for data. So the platforms that manage all that data, they gain immense financial leverage. Think of companies like Databricks and Snowflake. They're like the modern oil refineries of this new era. The more data that flows through them, the more valuable and sticky they become. But at the end of the day, what does the market really care about? It's this. It's the measurable impact on the profit and loss statement. Vertical-specific companies like Palantir and government or FICO and fraud detection, they can show those direct, quantifiable results, and that is exactly what investors are going to be looking for. But look, to get the full picture, we have to be honest and look at the other side of the coin. We have to consider the strong counter-argument. What if all this excitement is a bit misguided? What if the value creation is actually really narrow and the costs are way, way higher than anyone is anticipating? And this table just lays out the central debate perfectly. On one side, you have the exuberance case, broad value creation, strong pricing power, durable advantages. But on the other, the steelman case says, not so fast. It argues that super high costs, fierce competition from open source models, and serious margin erosion will mean the real gains are limited to just a handful of big infrastructure players. And if you want a real-world, concrete example of this, just look at OpenAI. Their costs for inference, that's just the cost of actually running the AI models for users, are staggering. They're growing nearly as fast as their revenue. It's an incredibly powerful example of how easily the operational expenses of AI can just eat your profits for lunch. And this isn't just a problem for the massive model builders. I mean, look at these numbers. The data shows the vast majority of firms are seeing the profit margins get squeezed by AI costs, and they're missing their project forecasts. Plus, on top of all that, you have the rise of these powerful open-source models that threaten to turn the whole space into a commodity, making it way harder for anyone to charge a premium.
So, okay, we have the bull case and we have the bear case. So what's the tiebreaker? How do we figure out who the real winners are going to be in the long run? How will the public markets separate the signal from all the noise?
Well, the source we're looking at lays out a super clear three-part test. It's a kind of litmus test for what will actually succeed. First, does it actually boost the bottom line? The impact has to show up on the financial statements, not just in a press release. Second, does it lock in your customers? Does it make it harder for them to leave? And third, does it become an essential, non-negotiable expense for the user? This is the framework that's going to separate the hype from real defensible value. So what does this all mean for the market? Well, don't expect a rising tide that lifts all boats, where every company with AI in its pitch deck goes up. Instead, we should expect what's called a concentrated re-rating, a decisive revaluation of the very specific companies that can actually pass those three tough tests. The winners will win big, and the others, well, they won't. And that brings us to the single most important takeaway from all of this. The next phase of the AI revolution isn't going to be judged by futuristic demos or exciting stories. It's going to be judged by the cold, hard numbers on a balance sheet. The defining feature of this cycle won't be irrational hype, it's going to be rational accounting.